Low-risk, high-return investments. My complete portfolio breakdown. You've got $50,000 sitting in your savings account right now. Maybe it's $30,000, maybe it's $100,000. The exact number doesn't matter. What matters is this: you're terrified to invest it. Every time you think about putting that money into the market, your brain immediately jumps to 2008, to people losing their homes, their retirement, and everything. So you leave it in savings earning 4%, maybe 5% if you shopped around, and you tell yourself, at least it's safe. But here's what's actually happening. Inflation is running at 3% per year, which means your safe money is only growing at 1–2% in real terms. Over 10 years, you're going to lose 20% of your purchasing power. Your safety is costing you a fortune, and the worst part, there's a way to get 8%, 10%, even 12% returns with less risk than you think. I'm going to show you my exact portfolio, every single position, the exact percentages, and the mathematical reason. Each one is there. My name is John, and I spend way too much time thinking about how to build wealth without losing sleep at night. If you're someone who has money to invest but can't pull the trigger because you're terrified of losing it, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because I'm about to break down my entire portfolio in a way that no one else is willing to do, with actual dollar amounts, actual positions, and the real strategy behind each decision. Here's the thing. When most people hear low risk, high return, they immediately think it's a scam. And look, I get it. That phrase has been used to sell everything from timeshares to crypto Ponzi schemes. But here's what most people don't realize. Low risk doesn't mean no risk. And high return doesn't mean 50% per year. Low risk, high return actually means something very specific. You're getting paid more than you should be for the amount of risk you're taking. That's the whole game. The problem is that most people have no idea how to measure risk, so they end up in one of two camps. They either take no risk at all and leave everything in cash, or they take massive risk chasing returns they saw on TikTok. Both groups end up poor. So let me show you what actually works. I'm going to walk you through my portfolio piece by piece, explain exactly why each position is there, and show you the math on how this generates returns that beat the market with significantly less volatility. My portfolio is worth $487,000 as of January 2026. I'm going to round it to $500,000 for easy math, and I'm going to show you exactly how it's allocated and why. Let's start with the foundation. Position 1, 40% in a total US stock market index fund, $200,000. Now you might be thinking, John, you just said this was low risk and you're putting 40% in stocks? Yes, because here's what most people get wrong about stock market risk. The risk isn't that. Stocks go down all the time. The risk is that you need your money the exact moment stocks are down. If you're investing money you don't need for 10 plus years, the US stock market is one of the lowest risk investments that exists. And I can prove it. Since 1926, that's nearly 100 years of data, the S&P 500 has never had a negative return over any 20-year period. Never. Not once. Not during the Great Depression, not during World War II, not during the 1970s stagflation, not during 2008. If you had the worst possible timing and invested at the peak right before every major crash, you still made money over 20 years. But here's where it gets really interesting. Over any 10-year period, the S&P 500 has been positive 94% of the time. That means there's only a 6% chance you lose money if you hold for a decade. And the average 10-year return? 9.7% per year. So when I say I have 40% in stocks, I'm not gambling. I'm taking a calculated risk with a 94% probability of success and an expected return of nearly 10% per year. That's not risky. That's actually one of the safest bets you can make. I use a total US stock market index fund, specifically something like VTI or VITSAX, because it gives me exposure to every publicly traded company in America, about 600 companies. If Apple has a bad year, Microsoft might have a great year. If tech struggles, healthcare might boom. I'm not betting on individual companies, I'm betting on American capitalism as a system, and that system has a 100-year track record of going up. Let me be clear about something. This is not the exciting part of my portfolio. This is the boring, foundational, this is how wealth gets built part. But this $200,000 position is probably going to be worth $320,000 in 5 years and $518,000 in 10 years if historical averages hold, That's $250,000 in gains from doing absolutely nothing. Position 2, 20% in investment-grade corporate bonds, $100,000. Here's where most people completely misunderstand bonds. They think bonds are for old people. They think bonds don't make any money. They think bonds are boring and useless, and they're wrong on all 3 counts. Bonds serve one critical purpose in your portfolio. They're the shock absorber. When stocks crash, and they will crash, it's not a matter of if, it's a matter of when. Bonds either go up or stay stable. This is what lets you sleep at night. But here's what's really interesting about bonds right now in 2026. We just went through a period where interest rates went from near 0 to over 5%. And when interest rates go up, bond prices go down. A lot of people got hammered on bonds in 22 and 23, but now we're on the other side of that. Interest rates have stabilized, and investment-grade corporate bonds, these are bonds issued by companies like Microsoft, Johnson & Johnson, Coca-Cola, are yielding between 5% and 6% right now. That's real money. That's $1,000 to $6,000 per year, or on $100,000 with very little risk. And here's the key. These aren't junk bonds. These are bonds from companies that have been around for 50, 75, 100 years. Companies that print money. The probability that Microsoft defaults on their bonds is basically 0. Now you might be thinking, but John, isn't 5-6% kind of low compared to the 10% you're getting from stocks? And yeah, it is, but that's not the point. The point is correlation. When stocks drop 20%, bonds typically go up 5 to 10%, or at least stay flat. That means when your $200,000 stock position drops to $160,000, your $100,000 bond position might be worth $105,000. Your total portfolio only dropped from $500,000 to $47,000 instead of down to $440,000. That $25,000 difference is the value of diversification. And here's the psychological shift that makes this work. When stocks crash and bonds hold steady, you have dry powder. You can sell some bonds and buy more stocks at a discount. This is how you turn market crashes into wealth-building opportunities without having to come up with new cash. I use a fund like BND or a corporate bond ETF like VCIT. Low fees, broad exposure, simple, nothing fancy. Position 3, 15% in real estate investment trusts, REITs, $25,000. All right, let's talk about real estate. Everyone knows real estate is a wealth builder, but most people think the only way to invest in real estate is to buy a rental property, become a landlord, deal with tenants calling you at 2 a.m. about a broken toilet. No thanks, REITs let you invest in real estate without any of that headache. A REIT is basically a company that owns and operates income-producing real estate. Apartment buildings, office buildings, shopping centres, warehouses, data centres, cell phone towers. And by law, they have to pay out 90% of their taxable income as dividends to shareholders. This means REITs typically yield 5 to 7% in dividend income. My REIT positions are currently yielding about 5.2%, which is $300 per year on my $75,000 allocation. But here's what makes REITs so interesting from a risk perspective. They don't move in lockstep with stocks. Real estate has its own cycle. Sometimes stocks are booming and real estate is struggling. Sometimes real estate is booming and stocks are flat. This lack of correlation, this is what reduces your portfolio risk. According to a 2023 study by Nareit analysing 30 years of data, a portfolio with 15% REITs had 8% lower volatility than a portfolio with just stocks and bonds, while maintaining nearly identical returns. You got the same gains with less stomach churning ups and downs. I split my REIT allocation across a few different sectors. About 40% in residential REITs, apartment buildings, about 30% in industrial REITs, warehouses and distribution centres, think Amazon, about 20% in data centre REITs, these are the buildings that house servers for cloud computing, about 10% in cell tower REITs. Why these specific sectors? Because they all have demographic or technological tailwinds. People always need places to live. E-commerce keeps growing, which means we need more warehouses. Everything's moving to the cloud, which means we need more data centres. Everyone has a smartphone, which means we need more cell towers. I use funds like VNQ for broad REIT exposure, and then a couple sector-specific ETFs. Total allocation, $75,000. Here's what most people don't realise. This $7,000 REIT position is generating $300 in annual dividend income that I can either reinvest or use as cash flow. Over 10 years, If REITs return their historical average of 9 to 10% per year, this position will be worth about $177,000. That's $100,000 in gains plus tens of thousands in dividends along the way. Position 4, 10% in Dividend aristocrats, $50,000. Now we're getting into the good stuff. Dividend aristocrats are companies that have increased their dividend every single year for at least 25 consecutive years. We're talking about companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, McDonald's. These are businesses that have survived recessions, wars, pandemics, financial crises, and through all of it, they kept raising their dividend. Why does this matter? Because dividend growth is one of the most powerful wealth-building tools that exists, and almost nobody understands it. Let me show you the math on this, because this is where it gets absolutely crazy. Let's say you buy a stock today that yields straight and you invest $10,000. You're getting $300 per year in dividends. Not bad, but not life-changing. But this company increases its dividend by 7% per year, which is the average for dividend aristocrats. Here's what happens. Year 1, $300 in dividends. Year 5, $420 in dividends. Year 10, $590 in dividends. Year 20, $1,161 in dividends. Year 30, $2,287 in dividends. By year 30, you're receiving $2,207 per year in dividends on your original $10,000 investment. That's a 22.8% yield on your original cost. The dividend is generating more money than your principal grew in your savings account. And that's just the dividends. The stock price is also going up over time. Historically, dividend aristocrats have returned about 10 to 11% per year, including both dividends and price appreciation. My $50,000 in dividend aristocrats is currently yielding about 3.2%, which is $1,600 per year. But in 10 years, if these companies keep raising their dividends at cent per year, I'll be receiving $348 per year in dividends from this position, and the position itself will probably be worth $130,000. I use a fund like Nobel, which holds all the dividend aristocrats, or I pick 15-20 individual aristocrats and build my own portfolio. Either way works. Position 5, 10% in international developed market stocks, $50,000. Here's a controversial take. The US stock market is expensive right now. Not bubble expensive, but definitely on the pricier end of historical ranges. The S&P 500 is trading at about 21 times earnings as I'm recording this. You know what's cheaper? International developed markets. We're talking about Europe, Japan, Australia, Canada. These markets are trading at about 14 times earnings. They're 33% cheaper for the same earnings. Now, I'm not saying international stocks are going to outperform US stocks. Historically, US stocks have crushed international stocks over the past 15 years. But here's the thing about investing. Past performance doesn't guarantee future results. And when you buy something cheap, you're stacking the odds in your favor. International stocks also provide diversification. If the US dollar weakens, international stocks go up in dollar terms. If US stocks struggle, international stocks might do fine. It's another layer of protection. My $50,000 in international developed markets is invested in a fund like VEA or VXUS. I'm not trying to pick individual foreign companies. I'm just getting broad exposure to wealthy, stable countries with mature economies. Expected return here is probably 7-8% per year, which is a bit lower than US stocks but still solid. And the correlation benefit, the fact that these don't always move in sync with US stocks, is what reduces overall portfolio risk. Position 6, 5% in high-yield savings, money market, $25,000. This is my emergency fund and opportunity fund rolled into one. It's sitting in a high-yield savings account earning about 4.5% right now. On $25,000, that's $1,120 per year in completely safe FDIC insured interest. Why do I keep this much in cash when I could be investing it for higher returns? 2 reasons. Reason 1, peace of mind. If my car breaks down, if I have a medical emergency, if something unexpected happens, I have $25,000 I can access immediately without having to sell stocks at a bad time. This is the money that keeps me from ever being forced to sell investments when I don't want to. Reason 2, opportunity. When the market crashes, and it will, I have $25,000 sitting on the sidelines ready to deploy. This is the dry powder I was talking about earlier. This is how I bought stocks in March 2020, when everyone else was panicking. I cannot stress this enough. Cash is not trash. Cash is optionality. Cash is what lets you be greedy when others are fearful. Never be 100% invested. Always keep some cash on hand, putting it all together. So let's add this up. 40% US stocks, $200,000, 20% corporate bonds, $100,000, 15%. REITs, $75,000, 10%. Dividend, aristocrats, $50,000, or 10%. International stocks, $50,000, or 5%. Cash to $5,000, or total, $500,000. Now here's where it gets really interesting. Let me show you the expected returns and actual risk profile of this portfolio, based on historical data and current market conditions. US stocks, 10% expected return. Corporate bonds, 5.5% expected return. REITs, 9% expected return. Dividend, aristocrats, 11% expected return. International stocks, 7.5% expected return. Cash, 4.1% return. Weighted average expected return. It's 8.8% per year. But here's the magic. Because these assets don't all move together, the actual volatility, the up and down swings, is way lower than if you were 100% in stocks. An all-stock portfolio has a standard deviation of about 18%. That means in any given year, you might be up 28% or down 8%. Those are big swings, hard to stomach. My portfolio with this allocation has a standard deviation of about 11%. I'm getting 8.8% returns with 40% less volatility than an all-stock portfolio. That's the holy grail. That's what low-risk, high-return actually means. Let me show you what this looks like in dollar terms over time. Starting portfolio, $500,000 after 5 years at 8.8%, $765,000 after 10 years at 8.8%, $171,000 after 20 years at 8.8%, $200,000 after 30 years at 8.10%, $638,000, and remember, this is with less risk than going all in on stocks. Now I know what you're thinking. But John, what about the year-to-year returns? What if I invest and then next year the market crashes? Great question. Let me show you how this portfolio performed during actual market crashes. During the 2008 financial crisis, the S&P 500 dropped 37%. A portfolio like mine would have dropped about 20%. Still not fun, but you're losing 40% less than the market. During the COVID crash in March 2020, the S&P 500 dropped 34%. This portfolio would have dropped about 19%. Again, significant cushion. And here's what really matters. Because you're losing less during the crashes, you recover faster. The math of losses is brutal. If you lose 5%, you need to gain 100% just to break even. But if you only lose 20%, you only need to gain 25% to break even. This portfolio recovers faster, which means you spend less time underwater, which means you can actually stay invested during the crashes instead of panicking and selling at the bottom. Look, I'm not going to sit here and tell you this portfolio is perfect. It's not. There's no such thing as a perfect portfolio, but this is the allocation that lets me sleep at night while still building serious wealth. I check this portfolio maybe once a quarter. I rebalance once a year if anything is more than 5% off target. Otherwise, I just let it run. And that's the whole point. The best portfolio is the one you can stick with through good times and bad. This is mine. Now here's the psychological shift that makes this work. You have to accept that you're not trying to get rich quick. You're trying to get rich slowly and reliably. You're playing a different game than the people chasing 100% returns on meme stocks. Your goal is to wake up in 10 years, check your portfolio, and realize you're a millionaire without ever feeling like you were gambling. And here's what most people don't realize. Getting 8 to 9% per year consistently will beat getting 20% one year, losing 10% the next year, gaining fat the next year, and losing 15% the year after. That. Consistency beats volatility every single time. So if you're sitting there with money and savings earning 4%, terrified to invest because you don't want to lose it, here's what I want you to do. Step 1. Open a brokerage account if you don't have one. Fidelity, Vanguard, Schwab, doesn't matter. Just open one. Step 2. Start with just 10% of your cash. If you have $50,000, invest $5,000. Build the portfolio I just showed you in miniature. You can literally buy all these positions with a few clicks. Step 3. Wait 3 months. Watch what happens. Get comfortable with seeing the number go up and down a little bit. Realize that the world doesn't end when your portfolio drops 3%. Step 4, add another 10%, then another. Over the course of a year, gradually move your money from cash into this diversified portfolio. By doing it slowly, you're giving yourself time to adjust psychologically. You're proving to your brain that investing isn't as scary as it thinks. And here's the thing, a year from now, you're going to wish you had started today. 5 years from now, you're going to be so grateful that you finally took action instead of just letting your money sit in cash, losing purchasing power to inflation. This is how real wealth gets built. Not through some secret investment strategy or insider tip, through simple, boring, diversified investing that you can stick with for decades. So that's my complete portfolio breakdown. $500,000 allocated across 6 different asset classes, generating an expected return of 8.8% per year, with significantly less risk than the stock market alone. If this helped you understand how to actually structure a low-risk, high-return portfolio, leave a comment telling me which position surprised you the most. I read every single comment and I'll respond. And if you want me to break down any of these positions in more detail, like how to pick individual dividend aristocrats or how to analyze REITs, let me know and I'll make that video next. Make sure you're subscribed because I'm doing a series on building wealth without taking stupid risks and you don't want to miss it. Now go build your portfolio. I'll see you in the next one.